There is a phrase in that title that needs to be addressed before anything else, because it is the phrase that has cost retail traders more money than perhaps any single piece of misinformation in the history of financial markets. The phrase is every time. It appears in course titles, in YouTube thumbnails, in sales pages for trading systems, in the promises made by signal providers and strategy vendors who understand that those two words trigger something in the human brain that bypasses critical thinking and lands directly in the part that wants to believe. Every time. The suggestion that a method exists which produces winning results without exception, without drawdown, without the fundamental uncertainty that is baked into the structure of every financial market that has ever existed. Understanding why that phrase is a lie, not a simplification, not an exaggeration, but a categorical lie, is the most important thing a trader can learn before evaluating any strategy, including the ones that genuinely work. Because strategies that genuinely work do exist. That is not the problem. The problem is what working actually means in the context of trading, which is almost never what people imagine it means when they first come to the market. Working does not mean winning every trade. Working does not mean never experiencing a losing week or a losing month. Working does not mean that following the rules of the strategy produces immediate, consistent, predictable results from the first day it is applied. Working means something far more specific, far more statistical, and far less emotionally satisfying in the short term, which is exactly why it is rarely described accurately by the people selling trading education, because accurate description does not sell nearly as well as the promise of certainty. To build a foundation for understanding what a real, functional trading strategy looks like, it helps to start with a concept that most retail traders have heard, but few have genuinely internalized, which is the concept of edge. An edge in trading is a statistical advantage, a set of conditions under which, over a sufficiently large sample of trades, the outcomes skew in a predictable direction. Not dramatically, not overwhelmingly, just enough that the aggregate result over time is positive, assuming the trades are sized correctly and the rules are followed consistently. A coin that lands heads 55% of the time has an edge. It still lands tails 45% of the time. Over 10 flips it might land tails 7 times. Over 20 flips it might appear to have no edge at all. Over 10,000 flips, the edge becomes undeniable in the data. Trading works the same way, and the failure to understand this, the expectation that an edge should be visible and confirmable over a small number of trades, is responsible for enormous amounts of wasted money as traders abandon working strategies during normal losing periods, because those losing periods feel like evidence that the strategy doesn't work. A real trading strategy has several components, and each of them matters not in isolation, but in how they interact with each other. The entry criteria define when a trade is opened. What specific, observable conditions need to be present in the market for a position to be initiated? The stop loss defines where the trade is wrong, the price level at which the thesis behind the trade is invalidated, and beyond which continuing to hold the position is no longer justified by the original reasoning. The target or exit criteria define where the trade is right, either a specific price level, a defined risk-reward ratio, or a set of conditions that signal the trade has run its course. And the position sizing rules define how much of the account is at risk on any given trade, which is the variable that more than any other determines whether a strategy is survivable over the long run. What makes a strategy proven is not that it wins every time. What makes it proven is that these 4 components have been defined with precision, tested over a meaningful sample of market conditions, evaluated honestly without cherry-picking the best results, and found to produce a positive expected value over time. Expected value is the mathematical heart of the whole thing. It is calculated by multiplying the average win by the win rate, subtracting the average loss multiplied by the loss rate, and examining what remains. A strategy that wins 40% of the time with an average winner 3 times the size of the average loser has a positive expected value. It loses more often than it wins. Over any short period, it might look like a failing strategy. Over time, with consistent execution, it produces growth. A strategy that wins 70% of the time, but where the average loser is 4 times the size of the average winner, has a negative expected value. It produces frequent wins and occasional catastrophic losses. And over time, it destroys capital regardless of how confident the trader feels during the winning stretches. Most traders who blow accounts are running the second type of strategy without knowing it, because the win rate feels good. The wins feel like confirmation, and the rare large losses are always explained away as anomalies rather than recognized as the structural feature they actually are. The strategy that works, therefore, is not defined by what it does on any individual trade. It is defined by its mathematical structure and by the discipline with which that structure is maintained across a large sample of trades. This is an abstract concept that becomes very concrete when real money is on the line, because the discipline required to maintain the structure, to take every stop, to hold every winner to its target, to skip trades that don't meet every entry criterion, to keep position sizes consistent regardless of conviction, is far greater than most people anticipate when they are learning the strategy in a calm, rational state without live exposure. One of the most reliable and well-documented approaches in trading, not because it wins every time, but because it has been tested across decades, across multiple asset classes, across different market environments, and has consistently demonstrated positive expected value when followed with discipline, is the framework built around the concept of price structure combined with defined risk. This is not a single indicator or a specific pattern. It is a way of reading the market that acknowledges what price is actually communicating, rather than imposing a predetermined narrative onto it. Markets move in identifiable structures. They form levels where buying and selling have historically concentrated. They create patterns of higher highs and higher lows in uptrends, lower highs and lower lows in downtrends, and ranges where neither direction has clear dominance. These structures are not magic. They are not predictive in the sense of telling you what will definitely happen. They are probabilistic. They identify conditions under which the probability of a move in a certain direction is higher than random, which is all that is needed for an edge to exist. Trading from areas of confluence is the practical application of this thinking. Confluence means the alignment of multiple independent factors that all point in the same direction. A price level that is simultaneously a previous area of significant support, a round number that has historically attracted attention, and a point where the current retracement in an established trend might logically pause. That level has more weight than a level identified by a single factor alone. It doesn't guarantee a reaction. Nothing guarantees anything in trading, but it raises the probability, and probability management is the entire game. The entry is taken when price reaches that level and displays a specific behavior, not immediately, on the assumption that the level will hold, but after the market provides a signal that the expected reaction is beginning. That signal might be a specific candlestick pattern, a reversal in momentum on a lower time frame, a failure to break through the level after multiple attempts. The exact nature of the signal matters less than the principle behind it. Waiting for confirmation before committing capital, rather than anticipating and hoping. The stop loss in this framework is placed at the point where the confluence level is definitively broken, where price has moved far enough beyond the level that the thesis is no longer valid. This is a specific, defined, non-negotiable exit. The distance between the entry and the stop determines the position size. If the account risk per trade is defined as 1% and the stop is 20 pips away, the position size is calculated so that if the stop is hit, exactly 1% of the account is lost. This calculation happens before the trade is opened, not after, and it happens the same way every time regardless of how strong the setup looks or how high the conviction is. Conviction does not change probability. It changes behavior, and usually not for the better. The target is set at a distance that provides at least a 2-to-1 reward-to-risk ratio, meaning the potential gain if the trade reaches the target is at least twice the potential loss if the stop is hit. Some approaches use 3-to-1 or higher. The specific ratio matters less than the consistency with which it is applied. With a 2-to-1 ratio, a strategy only needs to win 1/3 of its trades to break even. Win 40% and it is profitable. Win 50% and it is significantly profitable. These numbers feel unimpressive compared to the promises made by most trading education content, which is exactly why they are realistic. The market does not offer high win rates combined with high reward-to-risk ratios. Strategies that promise both are either being tested on too small a sample, cherry picked to show favorable periods, or selling something. Real strategies offer a trade-off. Higher win rates come with lower reward to risk ratios and vice versa. A trader's job is to find the point in that trade-off where their psychology allows consistent execution, because the best strategy mathematically is worthless if the trader cannot follow it psychologically. The time frame on which this framework is applied matters, and the answer is less about which time frame is better and more about the relationship between multiple time frames. The higher time frame, weekly, daily, provides the context. It shows the dominant trend, the major levels of structure, the overall environment in which shorter term trades will be taken. The middle time frame, 4-hour, 1 hour, provides the setup. It shows the developing opportunity, the approach to a key level, the formation of the conditions that will trigger an entry. The lower time frame, 15-minute, 5-minute, provides the entry and the precise stop placement. Trading in alignment across these three layers means that a short-term trade is being taken in the direction of the medium-term structure, which is itself aligned with the long-term trend. When all three align, the probability is higher. When they conflict, when the short-term signal is pointing in the opposite direction of the higher time frame trend, the trade is avoided, regardless of how clean the short-term setup looks. This multi-time frame alignment requirement functions as a filter, and filters are one of the most undervalued tools in trading. Every filter that removes low-quality setups from consideration improves the overall quality of the trade sample, even if it means fewer trades. One of the most common mistakes in trading is overtrading, taking positions when the conditions are marginal, when the setup is almost but not quite there, when the confluence is partial rather than full. This happens because sitting on the hands and waiting is psychologically uncomfortable. The market is always moving. Opportunities appear to be appearing constantly, and the feeling of missing out on a move that could have been profitable is more immediately painful than the diffuse, statistical damage of taking low-quality trades. But the math is clear. A strategy with a positive expected value applied only to high-quality setups produces better results than the same strategy applied to every marginal opportunity that vaguely resembles those setups. Less trading, more patience, and higher standards per trade is a principle that consistently improves results and is consistently ignored by traders who equate activity with progress. The role of market conditions in strategy performance is another dimension that the phrase "every time" conveniently ignores. No strategy works equally well in all market environments. A trend-following strategy performs well in trending markets and poorly in ranges. A mean reversion strategy performs well in ranging markets and poorly in strong trends. A breakout strategy performs well when volatility expands and poorly when markets are quiet and breakouts repeatedly fail. Every strategy has conditions under which its edge is strongest and conditions under which its edge is minimal or negative. Understanding which conditions favor the strategy being used and having the discipline to reduce activity or stay out entirely during unfavorable conditions is a significant component of long-term performance that is almost never discussed in the context of strategy education. This means that a trader who uses a trend-following approach needs to be able to identify when the market is ranging and adjust accordingly, not by abandoning the strategy, but by recognizing that the current environment is not where the strategy's edge lies, and that preserving capital during that period is itself a form of performance. Coming through a ranging period with the account intact means the capital is available when the trend resumes and the strategy's edge returns. Coming through a ranging period, having taken a series of losses on trend trades that kept failing, means the account is diminished at precisely the moment when the conditions improve. The ability to read market conditions, not to predict where price is going, but to identify what kind of environment is currently present, is a skill that develops over time, and that significantly improves the results of any underlying strategy. Risk management deserves to be discussed not as a supporting element of strategy, but as the primary one, because it is risk management more than any analytical method that determines whether a trader survives long enough to allow an edge to play out. The mathematical reality of trading losses is asymmetric in a way that has serious implications for position sizing. A 10% loss requires an 11% gain to recover. A 25% loss requires a 33% gain. A 50% loss requires a 100% gain. A 75% loss requires a 300% gain. The further the account drops, the harder the mathematical climb back to the starting point, which means that large individual losses don't just hurt the account once, they compromise the account's ability to recover for an extended period afterward. The trader who never takes a large loss, who consistently keeps every loss within the planned small percentage, is not just protecting the account in that moment. They are protecting the account's capacity to compound over time, which is the mechanism through which any edge actually generates meaningful returns. Position sizing consistency is the behavioral expression of this understanding. It means that the 1% risk per trade, or whatever the defined parameter is, applies to every single trade, including the ones where the setup looks so strong that risking more seems obviously justified, and including the ones taken after a series of losses where risking less seems obviously cautious. Varying position size based on conviction or emotional state introduces a variable into the results that has nothing to do with the strategy's actual edge, and that variable tends to produce the worst possible outcomes: largest positions on trades that lose, smallest positions on trades that win, because conviction and outcome are not reliably correlated in a market driven by probability rather than certainty. Keeping size consistent removes that variable and allows the strategy's actual statistical properties to express themselves in the results. The process of testing a strategy before trading it with real capital is not optional, and the standards to which that testing is held matter enormously. Backtesting, going through historical price data, and identifying every instance where the strategy's entry criteria were met, recording the outcome of each trade under the strategy's rules, provides the initial evidence of whether an edge exists. But backtesting is subject to significant biases that inflate apparent performance. Hindsight bias means that patterns which are obvious in historical data were not necessarily obvious in real time. Curve fitting means that a strategy optimized to fit historical data may have captured the noise of that specific period rather than a durable edge that will persist going forward. Survivorship bias means that the assets being tested were the ones that still exist, which excludes the ones that failed, painting a more favorable picture of historical performance than was actually available to traders at the time. Forward testing, applying the strategy in real time, in a demo account or with very small real capital, and recording every trade in detail, addresses some of these biases by forcing real-time application without the benefit of knowing what happens next. It is slower, because it requires waiting for actual market conditions to present the setups, and it requires weeks or months of data to be statistically meaningful. But it produces a much more honest picture of how the strategy performs in current market conditions and how well the trader can actually execute it under real-time pressure, which is often significantly worse than backtesting performance suggests. If the strategy holds up through rigorous forward testing, maintaining the expected win rate, the expected average win and loss sizes, the expected maximum drawdown, then there is a reasonable basis for trading it with meaningful capital. Not certainty. A reasonable base basis. The psychological dimension of following any strategy through its inevitable difficult periods is what determines whether the strategy's theoretical edge is ever actually realized in practice. Every strategy, without exception, has losing streaks. The statistical inevitability of losing streaks can be calculated from the win rate. A strategy with a 50% win rate will produce sequences of 5 or more consecutive losses with a regularity that is entirely predictable from the math, even though it feels alarming every time it happens. A sequence of 7 consecutive losses on a strategy with a positive expected value is not evidence that the strategy has stopped working. It is within the normal statistical distribution of outcomes for that strategy. But it feels terrible, and the brain generates a compelling narrative that the strategy has broken down, that the market has changed, that the rules need to be adjusted, that this time is different. Acting on that narrative, changing the rules, abandoning the strategy, taking a large revenge trade to recover the drawdown quickly, converts a normal statistical losing streak into a genuine performance crisis. Staying with the rules, continuing to execute the strategy exactly as designed, and allowing the distribution of outcomes to to revert toward the expected mean. This is what allows the edge to reassert itself. But it requires a level of statistical understanding and emotional composure that is genuinely difficult to maintain when real money is being lost in sequence. The traders who make this work over the long run are not the ones who found a strategy that never loses. There is no such thing. They are the ones who found a strategy with a genuine edge, understood that edge well enough to maintain confidence in it through difficult periods, built the disciplined structures that prevent emotional interference from degrading execution, and accumulated enough trades over enough time that the statistical edge became visible in the results. That is the entire story. It is not glamorous. It is not the story that sells courses or generates viral content. It is the story of a repeatable process, applied consistently, over a long enough time horizon that probability does what probability does when it is given enough room to work. The title of this piece promises a strategy that works every time. The honest version of that promise is a strategy that works over time, not in every trade, not in every week, not in every month, but in the aggregate result produced by consistent application across a meaningful sample of market conditions. That distinction is the difference between a fantasy sold to people who are new enough to the market to believe it and a reality available to anyone willing to do the actual work of building a process, testing it honestly, and following it with discipline. The fantasy is more appealing, the reality is more useful, and the cost of chasing the fantasy, in money, in time, in the emotional damage of repeated cycles of hope and loss, is far higher than the cost of accepting the reality from the beginning and building something on it that actually holds up. Every strategy will lose trades. Every strategy will have drawdowns. Every strategy will go through periods where the edge is hard to see in the short-term results. The ones that survive those periods intact because the position sizes were right, because the stops were taken when they were supposed to be taken, because the rules were followed even when following them was uncomfortable, are the ones that eventually produce the results that brought people to trading in the first place. Not every time. Over time. And over time, with the right structure and the right discipline, that is more than enough.